Hey, good morning, everybody. This is Rob Barnes, Integrated Insurance Consulting. Today's topic is top life insurance planning mistakes and best practices. We're going to get right into the material and roll. You do have a Q&A box if you want to add questions along the way. We will have time to answer them at the end. So the financial services industry continues to evolve, and I've seen a lot of change during my career without a doubt. One thing I continue to see is less and less people are offering life insurance, and there's less support for clients out there in the world. With less experts in the business, it's more important that all advisors help their clients with accumulation, planning, and protection. And of course, we're your partner of choice, hopefully. Today, we're going to discuss the best practices to help you better serve your client protection needs. I'll share some things that unfortunately I've learned through the School of Hard Knocks so you can avoid that pain. Life insurance has become commoditized. Shopping on price alone can be a mistake your clients ultimately suffer from. We'll share some insight of price versus value. And just as robo-advisors don't cut it for most people, have limited value to their clients, so do the online and 800 number organizations selling life insurance today. See, the life insurance conversation is different than any other insurance. In life, death is not an if, it's a when. And some of your clients' wants and needs are best suited by owning some permanent insurance along the way. And with the advent of living benefits, where you can draw off of the life insurance policy if you need care, it makes these policies even more of a bedrock for any sound financial plan. Remember, it's protect first and then accumulate. And finally, since we don't have our own legal department on there, you'll note that I'm neither an accountant nor an attorney, but we work with a lot of stuff and are specialists in the business and estate planning uses of insurance. So when we look at reviewing insurance, we will be sharing our review kit with you, and it'll cover these top three things. But we're either reviewing, analyzing, and or evaluating a policy for people that have existing coverage. And when we review coverage, we need certain information to help you do that. The last annual statement is one of the more important things to have. And then perhaps the policy pages that show what the policy is, what the premiums are and such, gives us an idea of what kind of policy it is. And then we might have to work harder to see if a permanent policy is properly funded or not. When we're reviewing, it's important to look at address changes. Unfortunately, I see a number of policies that we've been involved in where somebody moved, they never informed us, never informed the insurance company, and then they call me after they discover this, and sometimes I get warnings that their policy has lapsed. When somebody gets married or has a divorce, that's a good time for reviewing. A birth of a child could cause, especially a first child, I should add, would cause us to need to review coverage again. Death of an owner or beneficiary might change circumstances for the client's household, and certainly any health changes or financial changes might cause the need for a review. So one of the things we do in a review is make sure we have the right beneficiary arrangements. It's important to add a contingent beneficiary. There are times when this doesn't happen. If mom and dad are out on date night and don't make it home, it's vitally important that there's some kind of contingency for that situation. Otherwise, you're going to delay timely payment and possibly have some strain in the household. If you name your estate as the beneficiary of a life insurance policy, it's rarely recommended, but this could potentially cause the life insurance to be, so to speak, taxed because of the probate procedures, and no need to do that. In fact, we'll be covering the importance of getting some policy outside of the estate as we see the high net worth marketplace changing here. We want to avoid having a minor be a beneficiary. So this is something I'm often contending with. If a married couple, we're doing typical mom and pop insurance, if you will, to protect the household, and we name the spouse as the primary. If they don't have legal documents in place, then they sometimes want to name the child. And that can delay things through a guardianship arrangement. And so the Uniform Transfer to Minors Act and other things might be a better way to do it. So if they knew who was going to be the trustee of their trust, they might want to name them under the UTMA and UGMA rulings, that those would be the guardians of the money for the children if there's no adult around. Disabled children, if you leave them as a beneficiary on your life insurance, it might cause any governmental benefits to be restricted or taken away totally. Things to keep in mind, and that's where special needs trusts come into play, and that's who you name for the beneficiary in lieu of your disabled child. And then there's certainly some situations where you have a spendthrift or a concerning child, maybe somebody that has a drug habit and such. And, a lot of people don't know this, but every life insurance policy has the ability to pay in lieu of a lump sum. It can pay money over time. So it's kind of like having an annuity income for them. And you can either create a trust to control those things for your concerning or spendthrift children, or, and of course, it could be a spouse in that situation, or, we can design with some carriers to lower your premium. As an example, let's say you had a 20-year term. We could design the 20-year term to pay over 30 years instead of a lump sum. And so at any point in time, if somebody passes, they can pay out an income versus giving the principal that might be spent away. So one of the resources in the kit we'll send along with the recording will be a beneficiary kit that'll give you some more guidance and detail to some of these situations. So other things I run into where grandparents buy some permanent insurance on the grandchildren, but they don't list a contingent owner. And it would be good to know if you want that left to the parent or actually to the grandchild themselves. And business ownership situations, a lot of people are unaware of this, but since 2006, we've had EOLI laws, employer-owned life insurance rules, and essentially what these rules say is if you don't comply by them, you could have your proceeds in a business situation deemed taxable, and therefore for those working with the client and the business owner there, that could be potential to have some lawsuits there if you didn't help a client understand these things. And so it does matter who your clients are working with to procure their insurance, and that they're abiding by these things and looking out for the client to protect them. And then certainly personal ownership for larger estates. This is more true than ever right now. We'll cover it a little bit more later, but we see the sunset of the estate tax laws changing in just less than 2 years now in 2026. And one of the things that you might want to do for clients is to move their coverage outside of their taxable estate so it doesn't make them cross over the line or become taxable. Now, the Goodman triangle is a situation I often encounter it more in a business situation than I do in a family. But the long story short, when you have 3 different parties involved in a life insurance policy, it should raise a yellow, if not a red flag to you, and there are ways to clean it up. So in a personal situation, what we see, the husband is the insured, the wife owns the policy on the husband, but they have the kids as the beneficiary. And that's likely to be looked at as a gift from mom to the kids. And of course, if it goes over certain parameters, it can be negative. So you might want dad to own his own policy in that situation, or you might want to use a trust as an alternative to make sure that you're getting the money to the kids as you want to without any gifting exposures. In a business setting, the typical one that I see is we insure the business owner. The corporation is owning the policy. And this is true even if it's a solo corporation kind of a situation, and they make the spouse the beneficiary. Well, that's probably going to be looked at as some type of income taxation to the spouse coming from the company. And the simple way to clean it up would be one, not even have the coverage in the business. We often see that overly abused, if you will, especially if we don't want to comply with the OLI laws. Just make it personal life insurance. The money is going to get to the family, and that's who you're primarily trying to take care of. So the best practice here, if the insured is not the owner and the beneficiary should be the same. That's a little guideline for you when looking at these things and when you're auditing insurance on your clients. So let's look at maintaining the right amount. Again, part of insurance review here still. Looking at the right amount of insurance. If somebody gets married or has their first kids, maybe we have to look at a new needs analysis. Maybe along the way, you want to question whether your client should be renting all of their insurance or owning some of it. And that's the difference between term and permanent insurance. And so designing the policy, today there's a plethora of different carriers and products and riders and features and ways that we can design insurance. And we can certainly help you every step of the way. So when we're looking at the right amount of life insurance, there's rules of thumb like 10 times income. Those are better than some things, but I don't typically use those. And there's a typical needs analysis in some of these programs that I see people use. Probably the biggest thing I see abused in them is that you use too high of a rate of return on the proceeds. In other words, if a spouse passes away and we're going to set up that lump sum to provide a monthly income, you want to use a conservative rate that you can actually yield for income. We don't want to be looking at growth rates of 8 or 10% because the portfolio needs to be designed to pay income to replace the lost spouse's income. So you can use these needs analysis that show paying off debt and final expenses and creating a supplemental income as needed, setting aside a college fund. But the most accurate way to do things for the purest and largest level is the human life value. This was Solomon Hebner, who set up the American College. And this is what was used in the 9/11 settlements with people and how they divided. They looked at somebody's earnings and what they would have made over their lifetime and judged in that capacity. So all of this deals with how high or low you want to set your safety net. Some people want to protect to the maximum, others want the minimum, and that's your personal choice, your client's personal choice. So I use a 2-question needs analysis because I want to talk about the future of their insurance program as well as the amount of their insurance program. And so my 2 questions are simply assuming I know what they earn as far as income. I'm going to ask one extra question. If we were to set aside a lump sum of money, Mr. Jones, to provide an income to your family, and pay out monthly, what kind of rate of return can you earn? Now, we'll get all kinds of answers on that. And with interest rates being up, I wouldn't argue with a 4 or 5% today at all. And, when you start getting 7 or 8%, I start thinking, no, that's a little aggressive. That's a growth portfolio, not an income portfolio. And so that number, it's just a guideline. It's just a starting point. I could use 10 times income. Insurance carriers at different ages, if you're under 50, they'll often insure you for 20 to 30 times your annual income, just to give you an idea of what they look at in human life value. And certainly carriers don't want people to have an incentive to be knocked off in life, so they don't want to over-insure them. But somebody making $100,000 a year trying to apply for $10 million of coverage, we better have some kind of idea that, hey, they're a pre surgeon status as far as a doctor, and they're going to be making really big bucks. That might fly, knowing that. But if their tendency is just to make the 100, we're not going to insure them for 10 million either. So an important question of best practice you might want to add to your mix is, do they want coverage to be there when they die, no matter the age? I get accused sometimes of trying to show clients permanent when I'm only trying to find the right term policy for them. And the point being is, do you think you might want coverage down the road longer than the 20 years that you're buying it? And if so, the right kind of term comes into play there, and we'll be talking more on that later. So when you're designing different policies, it really gets into how healthy they are. You'll note, for anybody that's already working with us, or our process piece that we'll send, our first step is to pre-screen your health. Why? Because it's good health that buys insurance, like life insurance or long-term care for that matter. And we need to start there. I'm not going to quote Superman or woman rates when I don't know anything about your health yet, because that's mismanaging expectations. And so how much do they want coverage? How long? How safe do they want their coverage? How do they want to fund their coverage? These are important. And you'll see in the low right corner there, I have a male 71 with expiring term. This is the point that I want to make. In fact, there's an interesting thing. If you read the AP Viewpoint stuff out there, they're recently kicking around a story about widowhood penalty. And they're talking about how a lot of female, in this case, a lot of females are left with less money, less assets, less income when the husband dies. And certainly that's a scenario where life insurance, permanent life insurance, might have been a big deal. So in the last couple of years, we've had a few 70-plus-year-olds who had their 10 or 20-year terms expiring, and they still wanted and valued, or you could even say needed, their life insurance coverage. And so, of course, at 70, their health might not be the same. And these are the challenges that we face. It's the difference of, owning or renting, and perhaps some people, you want to have discussions about owning some insurance, or at least put them in the position to change their mind later with quality term. So the second thing to look at when we're reviewing insurance is analyzing it. We want to look at, is it good, bad, or indifferent? Could we do better elsewhere? And this is where getting the original policy illustration for a term or permanent policy would be important. Getting current in-force ledgers for permanent policies to see how the funding's going. Are we on track? Do we need to adjust? Are we going to implode down the road? A lot better to know it at age 50 than age 70, when everything hits the fan. And so for those that are working with us or work with us in the future, for the fee only and fee-based people on the call, our process is to deliver to you, the advisor, a copy of the policy that's placed, a final design ledger, and a summary page on IIC paper. And the reason for this is we're helping you establish a baseline for your client. Here's where we are. Here's what we designed. And later down the road, you can always go back to that kit to see if we're on pace or not. And hopefully we are. You see, when it gets to permanent insurance, it gets a little bit more cloudy out there as to what's what. But there's really only two types of permanent in some degree. There's projected insurance. These are universal lives and indexed universal lives, or variable universal lives. And there's guaranteed coverages. This is guaranteed UL, whole life, and term. Term is at least guaranteed for a period of time on the level duration stuff. So for the projected policies, we want to ask for in-force ledgers that show the current billed premium. We want to ask for ledgers showing no more premiums, and we want to ask for ledgers solving to keep the coverage in force till age X or year Y. these are the things that help us properly audit or analyze these policies to see if they're on track or not. And then under the guaranteed side, are the guarantees intact? Are there any loans? Is this going to vanish or be able to pay itself at some time as it might have been shown or projected to do? Reduce paid up is the RPU there. Sometimes we'll pay up a whole life policy and be done with it. So we have premium to add the coverage they need additionally here. And then with term specifically, we want you to know we track rate locks and conversion periods on any term for products that we help your clients with. And it's important to do that to avoid that call that I get from that 71-year-old that, hey, I just got my 11th year premium on my 10-year term and it's 10 times or whatever higher than I was. And, we can't underwrite in 30 days for those people. So getting a heads up and an advance warning helps us a lot. Onwards, now a deeper or the deepest level of reviewing life insurance is to evaluate it. And this is where we might want to review some extra questions. We want to certainly screen their health, because if I'm going to compare what you have today to what you might want to have today, or just compare it to other things and know if it's a competitive and worthy policy, I need to know your health. If your health has changed, your policy is worth a lot more, isn't it? You can't go out and buy the same stuff. I'm working with a couple of business owners right now. It's a just open case with a fee-only advisor. And I came into it, they wanted a second opinion because their Northwestern agent was showing them conversion options that were expiring. They bought some term, they were at the end of it. And what happened is by the time I was brought into the situation, the conversion option period was gone. The policies, they didn't pay the higher premiums and they lapsed the coverage and they're unprotected right now. And unfortunately, they're not so healthy. There's some big guys, I'll say. And so having had the ability to convert to some of the Northwestern stuff might have been their best option, but it's too late now. That's passed by. The importance of tracking the term and expiration dates and jumping on it well in advance. And so in addition to pre-screen, we'll ask about current insurance goals, objectives, and concerns. And the life insurance conversation, this is something that I'll continue to put out more insight from a long tenured experienced agent myself, that it's just a different conversation than anything else. It's not like long-term care or disability where you may or may not have a claim. In life, not even taxes are guaranteed, as the old saying is, just death is. And so we find that if you just ask the questions and look at things, and I know that a lot of fee-only, fee-based shy away from any permanent coverage, a large part because they don't understand it, or unfortunately, they always think they're going to out-invest it, and they're using an investment lens instead of a risk management lens to a degree. So to evaluate, we need to compare coverage. Is their policy good, bad, or indifferent? Maybe it's changed. This is what we get a lot. My client's retiring. They no longer really need this policy. So maybe we want to purpose the policy. In some cases, we had some earlier this year, they had perfectly good whole life policies, but they wanted to turn it into guaranteed lifetime income because they were retiring. Okay, we'll do that for you. And other people, and this is probably more common, they want to leverage it into some kind of policy because now long-term care is the bigger concern than it is. So again, tracking term, watching out for certain policies, these things are important along the way. Now, before I get into this, a few people might have come in after the 10 a.m. Central Time. I just want to emphasize, please do log 50 minutes on the call. So if you came in a few minutes late, stay through some of the Q&A. We need that for the CFP credit. And again, when you log off today, there will be a survey in your browser. We appreciate you filling it all in, but at least fill in your CFP code or let us know you're not a CFP so we don't hold things up. And lastly, our next first half of the year presentation will be May 15th. It is long-term care planning, what advisors need to know. This is a newly revised presentation. We turned our old one into a client version that we'll talk about that day. And we have a brand new presentation with some more meat on the bone to help you analyze things a little bit better. So sometimes policies need monitoring and adjusting along the way, and you have to have somebody tracking this stuff. And I want to tell you a quick story about Mr. Big. He's somebody that I've known for a long time. When I first met him at age 72, he had a blended whole life policy, and he was spending considerably more premium than the 120 that we did. And long story short, he needed it for estate planning purposes. He only needed the death benefit. He wasn't too concerned about cash growth, but he wanted some guarantees that things were going to be in place. And so we 1035 the policy into a guaranteed universal life contract and rolled over the cash value. And that's the first year premium you see here. So things went fine, and he paid his premiums the next 6 years. And after the 7th year, they had some business cash flow issues, and they wanted to lower their premium. And so one of the ways that we could do it in a GUL structure was we lowered the guarantee from lifetime down to age 95. It also encountered some other health things. We weren't sure he'd live to 95. We also weren't sure he wouldn't, to be clear, but it was their risk. And so we lowered the premium then, lowered the guarantees, and they paid the 90,000s for a few more years. And then in year 12 of the policy, the trustee made some snafus, ended up skipping the premium that year, got back on track for 3 more years, and then they skipped 3 premiums. And we had some issues going on. I was trying to reach out to the trustee at that time and was being ignored, if you will. And I'm going to pick up on this story a little bit later to tell you how it ended for you. So policies in motion, avoiding the school of hard knocks. Whenever you're whenever you're buying a policy, owning it in the right place is important. You know, should I own it in the business? Should I own it personally? Should I own it in an irrevocable trust? That type of thing. Replacing group life we'll discuss, 1035 exchanges, and ownership changes. These are all important areas to, wave a yellow flag and make sure you're doing the work. So I did refer to this earlier, the business-owned policies, the OLI rules, and on the board you see an 8925 form. And so the long and short of this, this stemmed out of a janitor owning, these laws stemmed from a situation where a Walmart owned insurance on a janitor. The wife of the janitor had no life insurance on him, and somehow after he died, she caught wind that Walmart got some proceeds and she got nothing. And at that time, it was totally legal to do that, and carriers do this for key people today. And this is where these EOLI laws stemmed from. And so now you have to be compliant with EOLI, and you can't just insure all rank and file employees in a corporation anymore, or you can't insure them with tax benefits, if you will. So the death benefit would become taxable for rank and file people versus being tax-free. And the government installed some document disclose and reporting rules. And so any business that owns a policy on anybody, including a sole owner of the business, since August of 06, you've had to be compliant with these. And I can tell you, I still run into avid insurance agents that aren't doing this with their clients, let alone other people that are farther removed from the insurance side of the business. So you need to be a director or a 5% owner or have compensation above 150 as of last year's rule. You need to be one of the highest 5 paid officers, or among the highest paid of the top 35% of all employees. So there's a number of different ways to still be eligible to have key person coverage in it, but just something to be aware of. Now, with these changes, in the estate tax laws, where the exemptions going down from 13.6 to about 7 million per person, some people, some of your clients might want to be considering moving their policies from the estate into an ILET. In fact, they can use some of the lifetime exemption there. And so when you own things in a trust, there's a cost to set it up. There's some maintenance, and you've got to deal with trustees. The other way to have things owned outside the estate is to have the children own it, but now the policy wouldn't be protected if your child owns it and they get into a lawsuit or a divorce, or perhaps they're a spendthrift. They invade your cash value and stuff because they have control of the policy. So trusts are usually more advantageous, but a little more work, no doubt. And this is something that you want to be aware of with this sunset of the estate tax laws coming up. Now, group life insurance, in fact, the industry about 4 or 5 years ago, I think it is now, we passed a milestone that there's more group insurance in place in the US than individual. And a lot of people, I understand the convenience of buying at work because it's automatically deducted from my pay, and I just sign my name, and I might get up to 3 or so times my income. All those things are good, but what's misunderstood about group is you think you're buying in bulk. You think you're getting a discount because you're buying with all the other people, and that the group was able to get a lower price and whatever. But the reality is not true. The reality is the healthier you are and the longer you're going to own coverage, the more you should have a standalone policy. Now, if your employer is paying the whole premium, that's a different story. But if you're paying your group, and the part that you are paying for is really what I'm talking about here. What often happens is people don't do the math the right way. You see, group plans are banded. And since you can just sign your name and get coverage, they let unhealthy people into the block. And so the healthy people end up subsidizing the unhealthy people. So what you should do, and in a business sense, we have a strategy called a group carve out, where we'll take the higher income executives and not give them all that group stuff, and we'll get something different for them that's more meaningful for the long haul, and they control it. So people just don't do the math. They don't find the information. You as an advisor might ask your client to get this stuff, and they never get it for you, and therefore you can't do the math if they don't give you the group stuff. But note here that if I add up the next 20 years for this 45-year-old for a $500,000 policy, they're going to spend on average $217 a month. Now, what often goes on, note that underneath to the right there, if they were just a non-smoker in the individual world, I can get coverage at $85 a month. And $85 a month is cheaper than today's 5-year bandit at $95. So I win right out of the gate. But sometimes the first category isn't the situation. If it was reversed, you would tell me, the client would tell us that, hey, I'm paying 85, you're charging me 95. Well, yeah, but your 85 is going to go up in 5-year bands, and it gets pretty expensive, as you can see. So when appropriate, it's worthy of replacing group. And you look at how long people stay on the job these days. They change their jobs, or employers will change their benefits as they have cash flow strain. And these are all things that we can help clients with. If they have a standalone policy that has a locked-in rate for 20 or 30 years, even good convertibility, or maybe some extra benefits out there, we are going to be better than the group, is the bottom line, and something they should go forward with. Now, here's one where I have a little egg on my face. You might have heard the word step transaction and the word booty, but have you ever heard them together? And this was a situation I learned through the School of Hard Knocks, where I thought I understood life insurance. I will say it was 20 plus years ago. I was changing jobs. I had this whole life policy, and I needed to take some money out of it. So I took a loan out of it. In fact, excuse me, I didn't take a loan. I surrendered some of my dividends for my that were, I thought, were my basis. You know, under life insurance rules, it's FIFO, not LIFO. You can withdraw your basis. You have to borrow your profits. And so what I intended to do, I needed some cash in this career change I was making. And I withdrew my dividends. and then I 1035 the rest of the policy into a protection only policy. And that's when I learned that doesn't fall under Internal Revenue Code 72. It falls under 1031. You might be familiar with that with real estate exchanges. And that's where the word step transactions and booty come into play. And I got a tax 1099. And I was like, wait, I just took my basis out. I rolled over all my profits, but it was considered a violation. It wasn't under 72, it was 1031. And I had to pay tax on some of those dividends that I withdrew, was the long and short of it. So if you encounter an existing loan on a policy and you're looking to do something with that, have a yellow flag go up and call us and we can help. Other ownership changes that come along, avoid things like transfer for value, own it the right place for high net worth. We've addressed a little, have proper policy valuations, and be aware of the difference of gifting or selling policies as far as the laws go. And so these are all exceptions to the transfer for value rule. You can send it to the insured, a partner of the insured, a partnership they're involved in, or a corporation that they're an officer of. And in the estate situation, for high net worth people, understand that you're taxed on everything you own minus what you owe, plus the proceeds of your life insurance. So there's some people today, as an example, just quickly, in the state of Illinois, it's a $4 million exemption from the state estate taxes. And so if somebody was worth $3.5 million but had $1 million policy, that puts them over the line of $4.5 million. And unfortunately for Illinois, you're taxed from $1, not just the part that's over. And so with the pending laws, this might be something you want to start talking to your clients about. And when they make gifts or sell to a trust and so forth, be aware of how you value a policy. You might have to ask for some forms, 712, I think it is. I'm bad on my numbers, but it's a valuation that the insurance company can give you. And so there's three ways to value a policy. There's interpolated terminal reserve. This is often associated mostly with whole life insurance, and it's about equal with the cash value. There's PERC, which is an acronym for premiums minus expenses and reasonable charges. And then, of course, there's market value. Today, we have a vibrant secondary market. You don't want your policy at certain situations. Maybe you want to sell it to a stranger that will potentially make money off of it. So a good example of this is a business owner story that we worked with through the years here. And what started as a cross purchase. So business owner A bought a policy, owned the policy, and paid the premium on the policy for partner B, and partner B reciprocated. Well, some things happened in the business. They weren't happy with this. They wanted to unwind it. And one of them wanted to keep their insurance. One of them wanted to get rid of it. And so partner A ultimately wanted to put the policy into their ILET. And so what happened was we had to swap policies. We can avoid transfer for value by giving the policy back to the person that's the insured. So they both did that. Then our guy had to get his policy from his ownership into a living trust. Well, he put it in his living trust to start with, and he had to, I'm sorry, I'm too fast here. He did individually own it, then he put it into his living trust, and then he got it into an ILET. And in order to avoid what a 3-year rule is, where if he died within 3 years and had gifted that policy to the ILET, it would have come back into the taxable estate. So that's why he ended up selling it to them. And in order to sell it, we had to value the policy. And so we helped with that each step of the way. And so today, we're seeing too many people buy term insurance as if it's a commodity. Everybody wants the lowest price. They don't think about quality. and how they're shopping. And I'll address a little bit of commission free here as well. And so there's more to term than price is the reality of it. For those that are NAPFA members, there's an article that I posted a while back that talks about today's commoditization of term and what carriers are doing to strip down their policies and go an a la carte. And if you don't ask questions, if you don't know more, you might be sentencing your client to a policy that's not even convertible, which is not really good comparatively. And so we've all bought things. We know that price and quality are at two ends of the continuum. And as the saying goes, you'll never apologize for quality. And so this is why we help clients. When we send quotes out to your clients, for those that are fee only or fee based on the call, we send a spreadsheet of everybody based on the screening that we did, but we pull off of that spreadsheet a strictly term, which is just lowest cost, no concern for future flexibility. So I could even use a non-convertible policy there. If that's what they want, that's what they want. We like, especially in certain situations, think business owners here, think high income individuals that are later going to be high net worth individuals. Those are people where they might want to pay a little bit more and get quality term because maybe they're going to want to own some insurance later, and this gives them an option to do so. And then today, believe it or not, there's even policies in the term component, let alone the permanent, that offer living benefits, things like critical and chronic illness. And so these policies, I prefer these kind of policies for certain situations, especially blue collar tradespeople that can't get good disability. You know, if they have a critical or chronic illness situation, being able to draw off of that death benefit might be a big deal. And so having some contingencies in case what if becomes what now is the importance. Excuse me. Again, just want to emphasize, if you have questions, add them to the questions poll. We will answer them in a short while. I don't know if I'm running long or not, but I'm yapping as fast as I can to keep you up with the program, and we'll get to the Q&A in the last 10 minutes or less. So quality term, you know, it means you're buying it with a quality company to start with. There are certain companies I prefer not to work with, but they're in our arsenal. You know, I'm on staff at an insurance brokerage operation, so we have a plethora of carriers and products. And there's some that I prefer than others for all the right reasons. But, you know, knowing the historical performance of the company, the portfolio, the product portfolio they offer, their reputation, all these things matter. And you might not see this as easy as I do in these scenarios because I've been around a long time, and people tend to show their true colors over time as well as companies. And so term insurance, you know, knowing what happens after the level term period matters, knowing what our conversion options are matters, what are the limitations. And so what's optimal in term is you want a company that allows you to convert to anything they sell at the time you're converting, and you want a company that allows you the full length of the term to make that choice. Because today you're thinking, you know, the theory is I'll grow my assets, I'll have a bunch of assets, and so by the time I'm 60, 65, I won't need the insurance because I'll have this big pile. Well, stuff happens and life gets in the way, and that choice might change down the road. And that's the value of having quality convertible term. The look at things to look at it. If a 40-year-old female were buying a 20-year term, and she decided at age 60 she wants to convert that term, what we're showing on the top line is that carrier one has the best conversion option, and we can buy a guaranteed premium for the rest of her life at $15,000 if we were to convert that. Carrier two actually has good convertibility for the first 5 years, but after that, you're going to pay a substantially higher premium, and that policy is not guaranteed. So it could have a call for more coverage down the road. And carrier three, they'd be $21,000. It's better than no convertibility, better than option two, but not as good as option one. And so what I wanted to show you is look at the difference in premium. It's about 16, 17% more to have quality. And these are the things that we educate your client about. This is where we pull these off the spreadsheet to tell you what they are and how they work and all that. So to emphasize the importance of this and how stuff changes, I'm introducing a client chronicle. These are real life stories we've been involved directly with the client on, and we can tell you, and in this case, I know everything about the case because we were there along the way. And the best thing that these people did for these two business partners is they bought 10-year term. This was the cross purchase and moving around stuff I talked about, but they bought quality. And that turned out to save them because just 5 years into the policies, one of the partners was diagnosed with a life-shortening disease. He ended up having to resign from his thing, and there was they ended up selling the company they were involved in and all that. But this owner had a much shorter life expectancy, and he needed to keep his coverage to make sure it paid off and protected his family. And so we had two different policies, and they did different things at the end of the 10-year. One was going to take a huge step up in price after the 10th year. That's how most policies work. But more and more, in order to protect carriers from reverse selection, we see carriers issuing term policies where the death benefit substantially decreases after the lock-in period. And so he was going to have a 90% decrease. So long story short, this is policy A. The premium was going to go from 20 grand to 300,000 and increase from there afterwards to maintain that 7.5 million. And we were able to convert this to a permanent policy at 111 a year. And that was much better than paying the term. You see, converting to permanent doesn't mean that you're going to design things to last forever. In this case, we were designing stuff to last for 10 years because we were pretty sure he wasn't going to make it that long at this stage. His other policy was the most important to convert because of the fact it was going to drastically decrease. So the premium stayed relatively the same, but drastically decreased. And so on this one, just the way the conversion options went, we ended up paying 178 for 5 years, but it was going to last the policy for 10. And so this gives you a better picture of what goes on with these things. So where are people buying their insurance these days? They're doing 1-800-BUY life insurance. They might work with their career auto agent or so forth. They might take solicitations. I get them all the time from AAA. Buy my expensive life insurance. We think working with an insurance broker like us makes a lot of sense, and hopefully you do too. And what I want to emphasize here is some recent developments. A lot of people are NAPA members on the call, and you're anti-commission, and I get that part of things, but understand that commissions are just part of the distribution cost of a policy. And very recently, I had been wondering since 2019 why TIAA pulled out of the commission-free life insurance arena. And they were a very strong company with deep pockets. And then if you're not familiar with Haven Life, Haven was developed a number of years back by Mass Mutual. They decided to have another outlet for insurance to capture these commission-free people, and they just closed their doors earlier this year. So unlike annuities, there are some options out there in the commission-free world, and there's some places to look for there that are working with commission-free products, but they don't have any life insurance on staff. And so I won't say never, but it's going to be a long time before there's a vibrant marketplace in the commission-free world, like it or not. And I think a large part of it to do is it's life insurance and ICHI and so forth, but it deals with underwriting and health. And a large part of what I do is all about underwriting. It takes money and good health to buy insurance. So for those people who are kicking the can down the road to buy their life insurance, they might be making a fatal mistake if their health changes. And it's not about the quote, it's about delivering on what we've screened and showed. And that's where it's an artwork almost of what we do at times. So I'm running into our Q&A. And I will just reference that as part of matching the right policy for the goal at hand, avoiding, I just tell you a client that I've known for 30 years, his third 10-year term just ended its rate lock period. And when we bought the last 10-year term 10 years ago, he had told me, now I understand why you showed me some permanent insurance many years ago when we met. And I wish I would have taken you up on that. And now he's doesn't have insurance. And when he dies, his pension ends. He took a life-only pension, and so his wife's going to have a setback there. She's going to be one of those widowhood penalty situations. And so the theories and realities, measuring things correctly, I'll admit you might outinvest any of my permanent insurance, but that isn't risk management measurement tools. It's about safety nets. It's about making sure your clients don't fall too far. And so matching things and sometimes owning insurance is important. And so that's why we have life insurance conversations and discuss and educate on these to potentially save problems later happening. So I'm gonna fast forward here. We hope that I'm gonna get to Q&A. Actually, let me just see if there's any questions in there. Are there? Yeah, I have no questions in there, so I'm just going to carry on here. For those who came in late, please stay on and log 50 minutes. If you want to log off, you've done your penance if you came in on time, but I'll finish this, and if any questions are there, we'll get to them. But right now, there's no questions in queue. So the types of policies, I understand how these can be confusing, but we'll be building some presentations on life in pictures, demystifying life insurance, and some other things that we have on our agenda for later to help better educate you on these. But our name was chosen very carefully. Integrated Insurance Consulting. This is what we do. Whether you're a licensed advisor or non-licensed advisor, we can help you. We've established a dedicated process. You're the advisor. We're there to help you. If you want us to help in an advisory and consulting capacity, we can. If you want to just tell us, go get my client the 20-year term for $2 million that I recommended, we'll make them professional shoppers, sifting through the myriad of options, making sure they get the right stuff. And again, once everything's implemented, we'll deliver a kit back to you that establishes your baseline. And to end with our big Mr. Big story, I left off that the trustee skipped 3 premiums, and then something happened. Mr. Big had a major stroke. The trustee was very concerned, and she immediately mailed a $300,000 check to make sure the coverage wasn't going to lapse, because she didn't check in with me, but she called me after that check had a problem at the bank, and luckily it did, because what we were able to do was save her from sending in that $300,000. You see, there were enough premiums paid into that policy to last longer, and he ended up passing within a year of that stroke, and the full claim was paid. And because we knew immediately that, hold on, don't send that new check again. We don't think you have to pay that. We think we're going to be okay. The coverage is still running on the cumulative premiums we've paid. And that's the difference of working with an insurance pro. And some situations require tracking terms. So these pieces will all be sent. A highlight of the best practices here, beneficiary designation resource, and a top 10 mistakes to avoid. So all this material was captured in our presentation. We'll send those. we'll send these two articles about commoditization of life insurance, and one other one that I wrote for the NAPFA magazine, that your life insurance policy doesn't have to retire when you do. And lastly, we'll share our life insurance review, discussing the review, analyze, and evaluate pieces. And if you send that information, we can certainly help you look at life insurance and opine on it for your clients. So with that, I want to thank you for attending and learning with us today. I'll look at the questions again in a second here, but appreciate it. Mark your calendars for May 15th for our newly revised new presentation on long-term care planning, what advisors need to know. We will be unveiling a myriad of resources we built for you to help you leverage your time and educate your clients. And again, we'll be sending the kit and registering you for the CE. So I do have one question. Okay, so this is just a compliment. Excellent presentation, and thank you for letting us know. I am staying on for 4 more minutes. For those who came in late, stay on so we log you 50 minutes into the program. And if anybody has additional questions they want to ask in the Q&A, feel free. And outside of that, I'm gonna take a drink of water here and stop yapping and give you a moment to gather all what we talked about. And so again, when you log out, we appreciate you filling in your survey, at least put your CFP code. And I'm done unless I see any other questions, which I'll answer in the next few minutes. Thank you.